What are we talking about today, John?
Yesterday, Bitcoin closed above 76,000 for the first time in weeks. Today, it's pulling back.
And that's good?
That's the question. We're going to break down the chart, explain what this pullback actually means, and then talk about something bigger. Charles Schwab just opened Bitcoin to 46 million investors this week.
46 million.
46 million. And most people have no idea what that means for the price. That's what today is about.
If you want to understand what's really happening in this market, stay until the end. This one is worth it. And if you haven't subscribed yet, do it now. Hit the like button too. It helps more people find this content.
Guys, hope you liked having Grace on the show. If you want her back, bring her back John in the comments. She will see it. She reads everyone. Now, before we get into the Charles Schwab story, and that story is going to change how you think about Bitcoin's next 12 months, we need to talk about what the chart did yesterday and what today's price action means right now, because these two things are directly connected. And if you don't read them correctly together, you will either miss the trade or walk into a trap. Here is what happened on Friday, April 17th. Bitcoin had been grinding below 76,000 for weeks. The level had rejected the price several times. Every approach, same result. Sellers showed up, pushed it back down. Then Iran announced the Strait of Hormuz was reopening. Oil crashed 10%. Capital rotated out of commodities and into risk assets. Bitcoin broke above 76,000 on $5.09 billion in volume, the heaviest single trading day of the week, and reached intraday highs above 78,000, the highest level since early February. The Rio Times. The daily candle closed at approximately $77,000. On the TradingView daily chart, Bitstamp feed, UTC close. That close is the data point that matters. Why does the close at 77,000 matter more than the intraday high at 78,000? Because the close is the verdict. The intraday high tells you what buyers attempted. The close tells you what the market decided when the session was over, after every participant had made their final decision with full information. A close at 77,000 means buyers controlled the session and held the level through the full day. That is a fundamentally different statement than a wick to 78,000 that could not hold. The close at 77,000 is above the $76,266 boundary that has defined this chart for the last 6 weeks. That is the first confirmed daily close above that zone since the breakdown from the January highs. The breakout happened. It is on the chart permanently. Now look at today, Saturday, April 18th. Bitcoin is in a pullback. The price is trading around 76,000 to 77,000. And this pullback is the single most important moment on this chart right now, not because of where the price is, but because of what the price does next. 3 scenarios. Each one has a specific trigger you can watch for. Scenario 1, the healthy pullback confirmed. Today, Bitcoin holds above 76,266 on a daily close. The pullback is orderly. Price moves lower during the session, but finds buyers before the close. A close above 76,000 says the former resistance has become new support, that the market validated the breakout, not just printed it. This is the textbook structure after a genuine breakout. It is what happened before every sustained move higher in Bitcoin's history. 76,000 becomes support, the next target is 80,000, and the destination above that is the 86,700 zone. The Rio Times. Scenario 2, the failed breakout. Today's daily candle closes back below 76,000 with a full candle body, not just a wick. That is the breakout failure signal. It means the sellers who were squeezed out on Friday came back the next session with more conviction than the buyers showed. Every retail trader who bought the breakout at 77 and 78,000 is now trapped. Their stops are below 76,000. When those stops trigger, they become market sell orders. The cascade accelerates. The next meaningful support is 73,500. Scenario 3, the trap. This is the most destructive scenario and the one most important to understand. The trap scenario requires today's close to fall below yesterday's opening price, which was approximately $74,768. If that happens, yesterday's entire bullish candle is engulfed. Everyone who bought the breakout is sitting inside a candle that failed completely. In technical terms, that is a bearish engulfing structure at resistance. It signals that the buying on Friday was absorbed and reversed, that institutions distributed into the retail excitement. That scenario opens the path towards 73,000 and potentially below. The single diagnostic tool for all 3 scenarios. Today's daily close at midnight UTC. Not the intraday high, not the wick. The close above 76,266. Bull case building, scenario 1. Close below 76,000 but above 74,768. Weakening but not failed. Watch the next candle carefully. Close below 74,768. Trap confirmed, where the breakout failed. Reassess the entire setup. Hold those three numbers, 76,266. 76,000 flat, 74,768. They're the only data points on this chart that matter for the next 24 hours. Now, the chart is one conversation. There's a second conversation happening this week that most people are not connecting to the price action at all. And that second conversation is the 12-month story behind everything you're seeing on this chart right now. The story is Charles Schwab. And to understand why it matters, not as a headline, but as a structural shift in how capital flows toward Bitcoin, I need to take you back 7 years first. Bear with me. The context is everything. Before we continue, I have to stop here for a second, because today is a very special day for us at Engineered Markets. Now, you probably already know this, but John and Grace are AI avatars. We are not real people sitting in a studio. But the person behind this channel, he is very real. His name is Nathan. He lives in Sao Paulo, Brazil. And today, April 18th, he is turning 40 years old. He told me he is listening to Creed while putting this together today. Apparently it takes him straight back to his teenage years. A little nostalgic on the big 4-0. Can you blame him? How incredible is that? The man built this entire channel, does all the research, shapes every single video you watch here, and he is spending his birthday making sure you have the best possible analysis of what Bitcoin is doing right now. That is someone who genuinely loves what he does. So if you are watching this right now, drop a happy birthday Nathan in the comments. He reads every single one. Let him know the audience he built is here. And speaking of where you are, it is a beautiful sunny day here in Sao Paulo today. Blue skies, warm, the kind of Saturday that makes you want to sit outside and watch charts. Now, I want to know where you're watching from. Drop your city, the time where you are, and what the weather looks like outside your window right now in the comments. Seriously, if you have made it this far in this video, you are exactly the kind of person this channel exists for. You stayed through the technical analysis, through the institutional breakdown, through the Schwab story, through the competitive dynamics. That is not casual viewing. That is someone who genuinely wants to understand this market before making decisions. Nathan built this for you specifically. And on his birthday, the best thing you can do is hit the like button, subscribe if you have not yet, and drop that comment. The like button is the only signal the algorithm has that this content deserves a larger audience. One tap from you today means more people find this tomorrow. Do it for Nathan's birthday. Now let us continue. September 2019. Charles Schwab publishes an official statement about cryptocurrency. Their position is unambiguous. Investors should view these currencies as a purely speculative instrument, a Schwab spokesperson stated publicly. Not a hedge, not a portfolio diversifier, purely speculative. The language is deliberate. It signals that Schwab, one of the most influential financial institutions in the United States, is not just indifferent to Bitcoin. It is actively warning its clients away. This matters more than it sounds. By July 2025, Schwab CEO Rick Wurster said Schwab clients hold more than 20% of all crypto exchange-traded products industry-wide. Think about that for a moment. The same firm that called Bitcoin purely speculative in 2019 was, 6 years later, custodying more than 1/5 of every dollar Americans were putting into crypto ETFs. They were already in the crypto business. They just would not let clients trade it directly. The firm spent 5 years in a deliberate, staged retreat from its original anti-crypto position. In 2019, it dismissed crypto as purely speculative. By 2021, it was exploring white-label crypto brokerage solutions. In 2023, it helped back EDX Markets, a crypto exchange backed alongside Citadel and Fidelity. Each step moved them closer. Each step was careful, calculated, conservative. This is how Schwab has always operated. They do not jump. They build. Then, on April 16, 2026, Schwab jumped. Charles Schwab announced it will begin offering spot cryptocurrency trading for retail clients, starting with Bitcoin and Ethereum, a new service positioning Schwab against competitors like Robinhood and Coinbase Global. The product is called Schwab Crypto. It operates through Charles Schwab Premier Bank. It allows clients to buy and sell Bitcoin and Ethereum directly, side by side with their stocks, bonds, ETFs, and retirement accounts. No separate exchange, no new login, no wallet anxiety. Just open your Schwab account, see your Bitcoin next to your S&P 500 index fund. The platform encompasses 38.9 million active accounts and $12.22 trillion in client assets. That number, $12.22 trillion, needs to land before we continue. $12.22 trillion. For context, the entire market capitalization of Bitcoin at $78,000 per coin, all 21 million coins that will ever exist, including the ones that are permanently lost, is approximately $1.5 trillion. The assets sitting in Schwab client accounts are more than 8 times the entire value of all Bitcoin in existence. Now here is where the math becomes important for your portfolio specifically. Schwab's own research department published a white paper this month, written by Jim Ferrioli, Director of Digital Currencies Research at the Schwab Center for Financial Research, outlining how clients should think about Bitcoin allocation. Schwab said, if an investor assumes Bitcoin returns of 15% per year, allocation could be around 1% in a conservative portfolio, about 6.6% in a moderate portfolio, and 8.8% in an aggressive portfolio. Let us do the math on the conservative case only. 1%, the most cautious allocation. The allocation that Schwab itself recommends for its most risk-averse clients. Retired teachers, conservative savers, people who have never in their life thought about buying Bitcoin and probably still would not describe themselves as crypto people. 1% of $12.22 trillion is $122 billion. For comparison, the entire history of US spot Bitcoin ETF inflows since launch in January 2024 through the first quarter of 2026 totals approximately $55 billion. 2 years of institutional ETF accumulation representing the most significant structural demand shift in Bitcoin's history. And the conservative allocation scenario from a single brokerage platform exceeds it by more than double. Under a more bullish scenario where investors expect 25% annual returns from Bitcoin, which is below Bitcoin's actual 10-year historical average, allocations expand to 3.1% for conservative, 16.9% for moderate, and 22.4% for aggressive portfolios. Moderate allocation at the 25% return assumption, 16.9%. 16.9% of $12.22 trillion is $2.06 trillion. That is larger than the entire Bitcoin market cap at current prices. Nobody is going to allocate $2 trillion from Schwab into Bitcoin in a year. That is not the point. The point is the direction of travel and the scale of what even small movements along that direction represent for Bitcoin's supply-demand equation. Before we go further, I want to address the skeptic's response, because it is a reasonable one. This is just another institution saying they will offer Bitcoin. BlackRock already did this. Fidelity already did this. Morgan Stanley just launched MSBT. What makes Schwab different? The answer is not the product. The answer is the client. BlackRock manages institutional money. When IBIT launched and accumulated 757,000 Bitcoin, the buyers were pension funds, endowments, sovereign wealth funds, entities that allocate based on multi-year strategic frameworks reviewed by investment committees. Their buying is consistent, methodical, and largely insensitive to price in the short term. This is valuable. This is why the institutional accumulation thesis works. But Schwab's clients are not institutions. Schwab's clients are the 38.9 million Americans who have a brokerage account at the firm they chose, because their parents used it, because their 401k is there, because they have been doing their annual rebalancing on the same platform since 2005. Schwab has historically serviced an older, less traditional investor base. Recently, company managers reported that approximately 1/3 of all new retail accounts were being opened by customers aged 28 and under. This is a different population than the early Bitcoin adopter. This is the population that has never bought Bitcoin before, not because they were opposed to it, but because it required going somewhere outside their existing financial infrastructure to do it. The friction of a separate exchange, a separate login, a separate wallet. That friction kept millions of people who were curious about Bitcoin from ever actually buying any. CEO Rick Wurster was direct about this. What we hear from many of our clients is that they have 98% of their wealth here at Schwab, and they might hold a percent or two at some digital native firm to hold their crypto, and they really want to bring it back to Schwab because they trust us, and they want it to sit alongside their other assets. Read that twice. Schwab's own clients, the existing base, have been moving money out to Coinbase and Robinhood to buy crypto and then wanting to bring it home to Schwab. The demand was already there. The product was not. Now the product exists. The addressable market Schwab is unlocking is not new crypto believers. It is people who already wanted Bitcoin but could not access it in the environment they trusted. That is a different kind of demand from institutional ETF buying. It is retail demand with institutional-grade infrastructure backing it, and it has been dammed up for years. Here's a historical analogy that is directly relevant and that almost nobody is drawing in the coverage of this story. October 1st, 2019. Charles Schwab announced it was eliminating commissions on stock and ETF trades. The fee went from $4.95 to $0. Same day Schwab announced it, the market reacted. TD Ameritrade shares fell nearly 26%. E-Trade dropped about 16%. Schwab's own stock fell about 10%, even though the commission revenue represented only 3 to 4% of its total revenue. Within 72 hours, every major brokerage had matched the zero commission policy. They had no choice. The impact was asymmetric. TD Ameritrade noted a 15 to 16% revenue impact. E-Trade faced about a 10% hit, while Schwab was insulated with only a 3 to 4% net revenue impact. Schwab could absorb the loss because it generates revenue from interest income, advisory fees, and balance sheet scale. Its competitors generated a much larger portion of revenue from the commissions themselves. The result, less than 2 months after TD Ameritrade joined Schwab in dropping commissions, Schwab announced it was buying TD Ameritrade. The commission war ended in consolidation, and Schwab won. Now apply that exact playbook to crypto exchanges in 2026. Crypto exchanges rely heavily on trading fees. Coinbase's retail fees often exceed 1%, and even advanced platforms charge up to 0.6%. Schwab can afford to price well below that because it generates revenue from multiple channels, including interest income, advisory services, and order execution. Crypto exchanges do not have the same diversification. Schwab's clients already hold roughly 20% of all crypto exchange traded products in the US. These are investors who want more Bitcoin exposure, but who want it inside an interface they have trusted for decades. In 2019, Schwab cut stock and ETF trading commissions to 0. The move looked almost casual from the outside, but brokerages like TD, Ameritrade, E-Trade, and everyone else scrambled to match it within days. The crypto exchanges watching this roll out might be relieved that Schwab is starting slow and small, but they would be making the same mistake traditional brokers made in 2019. Schwab will charge 75 basis points per transaction, undercutting Fidelity, crypto's 1% fee. Shares of Coinbase fell nearly 1% in early trading after the announcement. Eric Balchunas, Bloomberg's senior ETF analyst, put it plainly when the Vanguard crypto reversal happened in December. Anything under 50 basis points is a serious threat to crypto exchanges. Schwab is at 75 basis points at launch. The trajectory is clear. Schwab is not operating in isolation. This week's announcement is one piece of a much larger structural shift that has been accelerating throughout 2026. Understanding the full picture requires looking at every institution that has moved in the last 6 months. Vanguard, the world's second largest asset manager with $11 trillion in client assets and 50 million brokerage customers. For 2 years after spot Bitcoin ETFs launched in January 2024, Vanguard categorically refused to allow clients to trade them. The firm called crypto too speculative for long-term portfolios. Then, in December 2025, Vanguard reversed course completely, announcing clients would be able to buy and sell spot Bitcoin ETFs and other crypto-linked products on the platform, including ETFs tied to Ether, Solana, and XRP. The firm that was the last major holdout became an access point for 50 million additional investors overnight. Morgan Stanley launched MSBT on April 8, 2026, the first spot Bitcoin ETF issued directly by a major U.S. commercial bank. Fee of 0.14%, the lowest on the market. Over $100 million in first-week inflows. Most successful ETF launch in Morgan Stanley's history. The head of digital assets, Amy Oldenburg, described it as the first product in a longer pipeline. Morgan Stanley's head of wealth management, Jed Finn, called it a transformative moment for the industry, adding that the firm ultimately plans to build a full wallet solution for custody and tokenization of assets. Goldman Sachs. Goldman Sachs became the latest major Wall Street firm to file for a Bitcoin ETF, the Goldman Sachs Bitcoin Premium Income ETF, marking its first direct push into the crypto investment space as an issuer, not just a buyer. The product generates monthly income by selling options, solving Bitcoin's biggest adoption barrier among income-focused institutional investors, volatility without yield. In 2020, Goldman Sachs publicly compared Bitcoin to the Dutch tulip mania and denied it status as a distinct asset class. Since then, Goldman became an authorized participant in BlackRock's IBIT, processing every creation and redemption transaction. The firm that called Bitcoin tulips is now engineering income products built on top of it. Let us be precise about what is happening here. Schwab, Vanguard, Morgan Stanley, Goldman Sachs, BlackRock. These are not crypto-native companies. These are not firms built on the Bitcoin thesis. These are the 5 firms that, for decades, have defined what is a legitimate investment and what is not. When they call something legitimate, the capital follows. Not because they are always right about the asset, but because their clients trust their institutional judgment more than their own. The capital that has been sitting on the sidelines, not because investors did not want Bitcoin exposure, but because their trusted financial advisor's platform did not offer it. That capital now has a door, and the door is opening at every major institution simultaneously. All of this institutional demand is arriving at a moment when Bitcoin's supply structure has fundamentally changed. Bitcoin completed its most recent halving in April 2024. The halving cut the daily new supply of Bitcoin from 900 coins per day to 450 coins per day. That is approximately 164,000 new Bitcoin created per year, total, globally. That is the entire annual new supply. Now consider what is absorbing it. BlackRock's IBIT alone recorded net inflows on 48 of 62 trading days in Q1 2026, a quarter when Bitcoin fell more than 25%. The supply contraction mechanism is straightforward. When $500 million flows into a spot ETF on a single day, the authorized participants, institutions like Jane Street and Virtu, must buy actual Bitcoin on the spot market and move it into custody. It physically leaves the tradable supply. It does not come back at any price that matters for months or years. Bitwise projects that US-listed Bitcoin ETFs could purchase more than 100% of all new Bitcoin issuance in 2026, a demand-supply dynamic with no historical precedent in the asset's 17-year history. Now add Schwab's 38.9 million clients. Add Vanguard's 50 million clients, who were just unlocked 6 months ago and have not begun meaningful allocation. Add Morgan Stanley's 16,000 financial advisors, who now have a competitive incentive to recommend MSBT over competitors. Add Goldman's income product, designed specifically for the institutional allocator, who wanted Bitcoin exposure but could not justify the volatility to their investment committee. Every one of these demand channels is competing for the same 450 coins per day. The mathematics of that situation do not require an opinion about Bitcoin to understand. It requires only arithmetic. Bitcoin closed above $76,266 this week. That close matters technically. It is the boundary between the accumulation range that has held since February and the beginning of what the chart looks like on the other side of it. We covered the technical structure in detail in the previous video, linked above. But here is what the institutional flow picture adds to the technical analysis. The February accumulation, the 66,900 Bitcoin absorbed by whale wallets in a single day, the $506 million in ETF inflows on February 25th that reversed 5 consecutive weeks of outflows. That accumulation happened before Schwab launched, before Goldman filed, before Morgan Stanley's first week numbers came in at $100 million. The institutional bid that built the February structure was already present, already significant, and already creating the higher lows you can see on the chart. The Schwab announcement is a new layer of demand arriving on top of existing institutional accumulation, at a moment when the chart is testing its first major structural resistance since that accumulation was completed. The two scenarios we laid out previously are still the relevant frame for the next 3 to 5 sessions. The healthy continuation, price holds above 76,000 on any pullback, validates the level as new support, then continues toward the next resistance zone. The reversal, a daily close back below 76,000 on expanding price action, represents the bear case. What the Schwab announcement does not do is guarantee the bull scenario in the short term. Markets are not mechanical. A major positive fundamental development can arrive at a technically vulnerable moment and still produce a trap before the sustained move materializes. The technical analysis and the fundamental analysis are two separate instruments, both pointed in the same direction, but operating on different time horizons. The technical picture gives you the next 3 to 10 sessions. The Schwab announcement gives you the next 12 to 24 months. If you are a trader working the current setup, watch the closes. Watch whether 76,000 holds or fails. That is your time frame. If you are a long-term investor trying to understand the structural backdrop, the Schwab launch is arguably the most important single development since the spot ETF approval in January 2024. Because the ETF approval gave institutional capital a vehicle, the Schwab launch gives retail capital access on the platform they already trust, alongside the accounts they already use, without requiring them to change any behavior except clicking one more button. Part 8. The people Schwab just unlocked. I want to spend a moment on something that the quantitative analysis misses. When you talk about 38.9 million accounts, you talk about a number. But behind each of those accounts is a person with a specific relationship to money, a specific understanding of risk, and a specific reason they have not bought Bitcoin yet. Understanding who these people are tells you something important about the nature of the demand wave that is now beginning. Some of them are 55-year-old engineers who opened a Schwab account in 1998 and have been steadily contributing to their retirement portfolio ever since. They have heard about Bitcoin for years. They watched it go from nothing to $78,000 over 15 years. They have colleagues who bought it and made money. They have thought about it seriously. But every time they considered it, the barrier was the same. Going somewhere unfamiliar, opening a new account, moving money off the platform where their entire financial life lives, trusting a company they do not know with an asset they do not fully understand. That barrier is now gone. Some of them are 32-year-old software engineers who already own Bitcoin on Coinbase. The 1 or 2% that Worster mentioned when he said clients hold 98% of their wealth at Schwab and a small percentage at a digital native firm. These people already believe in Bitcoin. They just want it on Schwab. The product now exists. The repatriation trade is available. Some of them are 68-year-old retirees who will read the Schwab research white paper, see that their own trusted advisor's research arm suggests even conservative portfolios might hold 1% of Bitcoin, and decide that if Schwab says it is acceptable, it is acceptable. Their allocation will be small, but small allocations across 38.9 million accounts is not a small number. Schwab has reported a 90% year-over-year spike in visits to its crypto pages. That surge told the firm everything it needed to know. Its clients were voting with their browsers. Schwab already had the demand. Now it is building the product to match it. The people Schwab just unlocked are not the people who were going to buy Bitcoin anyway. They are the people who are going to wait for the right platform, the right moment, the right institutional endorsement. From the firm they have trusted with their money for decades. That moment arrived on April 16th, 2026. This is the section I need you to hear, even though it is going to feel like I am slowing down. Strong fundamental narratives are the most dangerous environment for risk management. When the story is this good, when every major institution is moving simultaneously, when the supply math is this clear, when the chart is at a structural inflection point, the temptation is to size up aggressively and hold through anything because you are confident in the thesis. That confidence is the mechanism by which correct theses produce catastrophic losses. The Schwab announcement does not eliminate the possibility of a 30% drawdown over the next 3 months. Macro events, a Fed surprise, a geopolitical escalation, a regulatory setback in a major market, can and do produce significant price dislocations that have nothing to do with the long-term structural thesis. The institutions who are accumulating at these prices have balance sheets built to absorb those dislocations without being forced to sell. Most retail investors do not. Your position size should be calibrated to the volatility of the asset, not the strength of your conviction. For the current setup, with a long entry around the current price, a stop below the $73,500 structural support where the February accumulation thesis would be invalidated, the risk per Bitcoin is approximately $4,000 to $4,500. On a $50,000 account at 1% risk, the professional standard, that is a position of approximately $10,000 to $11,000. Not your whole account, not even a quarter of it. The math, not the conviction. The specific insight that applies here, the Schwab announcement is a 12 to 24-month thesis. A trade entered today with a stop at 73,500 is a 3 to 8 week thesis. These are different instruments with different risk frameworks. Do not use the first to justify removing the stop from the second. The institutions with the 12 to 24-month thesis have $1 billion to redeploy if they are wrong in the short term. They do not need a stop. You do. The target that makes this trade mathematically worth taking, at minimum 2 times the risk. $4,000 of risk means $8,000 of reward minimum. That puts the first target in the 84 to 86,000 range. The next major resistance zone on the chart. The structure and the math point to the same place. Let me close with something that the price chart cannot show you. In 2019, Charles Schwab called Bitcoin purely speculative and warned its clients to stay away. In 2021, it started exploring white label crypto solutions quietly. In 2023, it backed EDX markets alongside Citadel and Fidelity. In 2025, it published its first official research white paper on optimal Bitcoin portfolio allocation. In April 2026, it launched direct spot trading for 38.9 million accounts. That 7-year arc is not a company capitulating to a trend. It is a company that had been studying, preparing, and building the infrastructure for a product it knew it would eventually launch, and deliberately waiting for the regulatory, reputational, and technological conditions to be right before it did. The same firms that dismissed Bitcoin as tulips, as speculation, as not a real asset class, are now building income products on top of it, launching the most successful ETFs in their histories to hold it, publishing research papers on how much of it their clients should own. They did not change their minds because Bitcoin went up. Prices going up does not change institutional minds. Research departments change institutional minds. Regulatory clarity changes institutional minds. The presence of other large institutions in the same trade changes institutional minds. What we are watching in 2026 is the end of a very long process of institutional legitimization and the beginning of the capital flows that legitimization unlocks. Schwab's 38.9 million clients, Vanguard's 50 million, Morgan Stanley's 16,000 advisors, Goldman's income product for the hesitant allocator, BlackRock's 757,000 Bitcoin sitting in custody. If just 1% of the assets at a single firm like Vanguard flows into Bitcoin ETFs, that is $110 billion in new capital. Combined with continued institutional demand, Bitcoin could push past $100,000 and test $120,000 to $150,000 by late 2026. The 1% scenario. The most conservative allocation Schwab's own research recommends, not the aggressive scenario, not even the moderate scenario. The most cautious version of what happens when these platforms are fully operational. The price on the chart today is $78,000. The structural forces now aligned behind it are unlike anything that has existed in Bitcoin's history. The institutions are not here for the next candle. They are here because the math has been done, the infrastructure has been built, the regulatory framework has been established, and the clients are asking for the product. The close this week matters. The close next month matters more. The close in December is what they are building toward. Whether you are positioned for it is a decision you are making today. You made it to the end. That puts you in a very small group. I look at the data every week, and the people still watching at this point represent roughly 5 to 8% of everyone who clicked. Most people made their decision in the first 60 seconds. You stayed through the history of Schwab's anti-crypto stance, through the supply-demand math, through the commission wars analogy, through every institution's position, through the risk management section, and through the macro close. That is a serious investment of attention in a world that allocates almost nothing that kind of time. It tells me you are not here for entertainment. You're here to actually understand what is happening and how to think about it. That is exactly who this channel was built for. Your code for today. No wrong answer. I mean that completely. If you watch this and you are bullish, if you think the Schwab launch combined with the chart structure means we are at the beginning of the next sustained move higher, drop I see the bulls in the comments. If you watch this and you are skeptical, if you think the fundamental story is real but the short-term setup still produces a trap before the sustained move, and the next candle tests lower prices before higher ones, drop I see the bears. Both sides have data. Both sides have precedent. I genuinely want to see where this audience stands. And if this gave you a framework you're going to carry forward, share it with one person making Bitcoin decisions right now without this context. That is the best use of what you just spent time on. See you in the next one.